A warm welcome to the Risk Reversal Podcast. Guy Adami, always joined by Nathan. And today, for the first time since April 15th, Cameron Dawson, the CIO, that's Chief Investment Officer of NewEdge Wealth, is joining us. Cameron, how are you?
I'm wonderful. I can't believe it's been so long. Happy to be here.
Can't believe it. Now, before we start, I recently saw something on the line about an award that was bestowed upon you at NewEdge Wealth. Please.
Oh, goodness. Well, NewEdge was just ranked as the third top RIA in the country by Barron's, which is an incredible honor. And we were in the Barron's magazine as well as in the Wall Street Journal with that article, which was pretty fantastic.
That's remarkable.
How many advisors?
If I had to guess, I don't know this. I think there are 350,000 advisors in the United States. Wow. Which means, if I had to guess, they're probably somewhere between 85 and 100,000 RIAs. That's a total guess.
Yeah, I mean, many RIAs, and it's a testament to how hard everybody at NewEdge has worked over the last just 4.5 years when we were founded. So we have our 5-year anniversary in December, so a lot to celebrate.
Well, it's a testament to you, if I'm being honest, because your visibility and the work that you do on the networks and on the podcast is second to none. As I mentioned, April 15th, you talked about a number of different things, not least of which this mullet strategy, party in the back, business up front.
I was expecting you to have a mullet when I came back.
For you.
You've had all this time to grow one out.
No,
so
I know.
I don't understand.
I don't think I've ever had my hair is what it is at this point in my life. Dan?
We'll put some pictures in the show notes. There's a couple pictures of you on the sideline of a football.
Yes, that's from that early 1980s.
There was a lot of hair back then.
There was a lot of hair.
So we don't even remember kind of what the mullet was, but you think about April 15th, it was tax day, and we were in the throes. I guess the market had just started to rebound after, the whatever you want to call it. I don't call whatever, I can't even say it. Liberation there
Day.
It is.
I thought you were saying Liberace.
Liber. I just think I don't know if people say that stuff seriously. Like, are they being sarcastic?
No,
when they say
I think most people say it the same way people say the big beautiful bill seriously is the same way
Were
they
they
talk
both
about.
meant to be jokes? That I honestly don't know, because people don't talk like that about serious things, right? Or no, I don't know. But we were just kind of coming off. We had a little bit of a V. It was a sharp rally off of those. We thought you get a little run, you get a little of this. We thought that, estimates had been coming down that whole month prior. I mean, people thought there was going to be a certain tariff rate, there was going to be a certain headwind to growth, that sort of thing. I think all of that went out the window. And by May, all the strategists had been moving their numbers down and the price targets down. They're all chasing their tails on the way back up. Mm-hmm. So give us a sense of, are we the opposite side of early April right now? Do you see what I'm doing there?
Yeah, I mean, what a different world that we're in today versus that April 15th. And I think that we have to think about thinking about today versus back then in kind of two key buckets. One is the fundamentals, which we'll talk about, but the other one is positioning. Mm-hmm. And I think if there's one thing that has driven this market more than anything else over the course of the last few months has been positioning. If you went to the beginning of the year, you had institutions that were in the 90th about percentile in their equity allocations. People were fully invested. You got to April and the low in positioning by that Deutsche Bank survey was at the first percentile. So 1% in history in the last 10-year period, I think they do a rolling 10-year period, that you had people more underweight equities, which just meant that people were not positioned for the V-shaped recovery. And the most wild thing that has happened over the course of the last few months is that despite this strength in the market, positioning has been actually rather slow to rebound. So even though we've thrown a lot of crazy things at this market, and there's been plenty of reason to have uncertainty, certain cohorts, meaning those institutional investors and mostly discretionary investors, so think equity mutual funds, equity long short traders, they've remained more on the sidelines than the equity strength would suggest that they would have, right. Which says that there's still room for them to get dragged kicking and screaming into this market, and potentially that's something that happens in the fourth quarter. Then it raises the question, what's that setup in 26 if everybody gets fully invested?
Right. Well, here we are in the fourth quarter. And, part of this, I think, passive investing leads everything. And to a certain extent, people that are trying to be tactical wind up having to chase. And I think that's what we're seeing now. So as we're now in October, the chase is on, and you're seeing it manifest itself in a number of individual names. The question is, to you, at what point does valuation start to matter? Because clearly, despite the fact that a number of metrics, valuations are at historic levels, and that's not hyperbole, nobody seems to care right now.
So valuation, it's one of the most overused but important tropes is that it's not a timing tool. And the way we think about valuations is that it's effectively an amplifier of whatever the direction of earnings moves are. So what I mean by that is that if you're starting from a low valuation and you have rising earnings estimates, that low valuation can amplify the potential upside because you have room for expansion. It happens on the downside as well. If you have high valuations and you're going into a period where earnings estimates are starting to level off or go down, you could have more downside because there's a lot more valuation compression to be had. So one of the reasons why we think valuations continue to press back to new highs is because earnings estimates continue to make new highs. So as long as you're in an environment where you're revising up earnings, it supports a risk-on tone in the market. Now, we can't talk about valuation without mentioning liquidity, and it's one of the most nebulous, sort of out there, I'd say we have to wear 10 hat whenever we talk about it, but we can observe that liquidity has been abundant. You can look at things like crypto doing really well, risky stocks, unprofitable stocks doing well, IPOs doing well. Look at tight credit spreads, look at high equity valuations, sort of a circular reference. But the point is, we're in an abundant liquidity environment. Question is, does that remain in 2026? And I think that very smart people like Michael Howell, who's kind of the master of liquidity as an analyst, suggests that maybe there's things to watch in 26 where liquidity could become less abundant.
Everything you just said about the liquidity environment reminds me of 2020 and 2021. Everybody wants to make, we keep hearing this comparison to the .com thing. It really reminds me a bit more of that period. So when you talk about what happens in 2026, are we talking about 2022?
Well, 2022 had a few flavors to it. The first one was liquidity got tighter. So we could talk about what could drive liquidity to tighten in 26. The other thing that 2022 is important is that you were cutting GDP estimates really materially. People were pricing in a recession. And you weren't just cutting GDP forecasts, you were cutting earnings forecasts. So what we have to do is look at GDP and earnings forecasts for 2026 and say, are they properly calibrated to what we think is underlying growth rates? Look at the GDP line. People are only estimating about 1.6% real growth. That doesn't seem like too much of a stretch. It's earnings that look like a little bit more of a stretch. They're sitting at about $302 a share. That number has been drifting higher because people are pricing in big productivity booms from things like AI, which we could debate as to whether or not we're actually seeing the productivity be a source of AI, or it's just kind of normal blocking and tackling that we see from corporates. So I think that when we think about 26 and the liquidity dynamic, one of the things to note is that we have to think about things like bond market volatility, which has been ever drifting lower. This is an observation from Michael Howe. He's like, look, you can't think about liquidity as just M2 money supply growth. You have to consider things like bond market volatility. That moving lower helps support liquidity. Things like how the Treasury funds itself with all these big, huge deficits, how they do that in the interaction of the Fed cutting interest rates. And here's one thing that we're watching really closely, or something to noodle on. One of the reasons why Treasury's been able to issue so much debt is because they've been issuing a lot of bills. They've been able to avoid having to issue bonds. And who's been gobbling up those bills has been money markets. We have $7.4 trillion of money markets because people are saying, well, I'm getting paid to sit in cash. It's great. And it's not just people, it's corporations. But as the Fed cuts interest rates, do we see money market balances start to level off? Does it become less attractive at the margin? And if it starts to level off, is there as much demand for all of these bills that are going to have to be issued to finance the deficit? And so then you start getting into these interesting, could we have some short-term funding whoopsie moments? Because remember 2018 in December, we had a short-term funding whoopsie moment and risk assets really didn't like it.
I do remember that. And I'll say this, I think part of the plan is exactly to thread that needle, hoping that the market will be fine buying the bills, we'll issue bills, rates will come down in the meantime, hopefully. And by the time they get down to a level that makes sense, we'll be able to issue duration stuff and the market will be fine buying our duration. I mean, I think that might be part of it.
Party on, Garth.
Right? Well, that's it.
I think the fascinating question on that is whether or not there are unintended consequences. Right. And it's the unintended consequences is where that liquidity discussion where things could get squirrely, right? So we published a Fed decision tree saying, okay, Fed cuts rates, what happens to long-term interest rates? If economic data is weakening, the Fed cutting rates and economic data weakening means long-term interest rates likely move lower.
Should
Move lower. But if economic data is strengthening, meaning we look at things like economic surprises moving higher, if that's the case, then the long end of the yield curve could go up like it did last year. If that's the case, then it means that rates still hurt housing. It means that you don't get the kind of CapEx cycles that you would think outside of AI, which has idiosyncratic drivers, which means you don't get kind of the uplift and growth that you would normally imagine that would come from interest rate cuts.
All right. Great conversation is a segue to a report that Torsten Slok put out, I think it was 4 days ago from Apollo. And he was talking exactly what you just mentioned, is this inconsistency between the weak labor market and accelerating GDP. And he's one of the first strategists that I've heard say this, I guess he's an economist too, is that maybe we should be rethinking rate cuts. So like you just talked about that 2020-21 period, what was different that time is that rates were about to go up, right? And now it's that rates are supposed to starting to kind of increasingly go down. We had 100 basis points last year. We just had 25 basis points. We're expecting another 75, right, over the next few months or so. But what if that were to change?
Yeah. So I think it's really fascinating to contrast the communication coming out of somebody like Stephen Myron, who's arguing that you should be cutting rates by a lot because you are so far above neutral that it is inevitable that you're going to see that high rate weigh on growth, so you need to get ahead of it. He's arguing that neutral is far lower because of things like immigration policy, lower growth in the labor force, as well as some arguments about savings rates and government deficits, et cetera. But that's a very different argument, because it's saying if we don't change, things will get weak, versus the Bowman and Waller and folks like Steve Dutta, who I know has come on the podcast. We're arguing, saying things are already weak.
Right.
And that you need to cut because it's just going to get even weaker. And that's where we have to understand that the Fed's mandate is about unemployment, not about growth. So growth in the economy is holding up okay because growth in the economy is coming from a very narrow part of the economy related to AI CapEx and tech spend that is not necessarily resulting in more jobs. And so you have this environment where it's sort of a jobless growth period, kind of similar. Remember, we had a jobless recovery in the early 90s coming out of the savings and loan crisis. So we've had jobless recoveries, but this one has this flavor of the fact that companies are still able to grow earnings, corporate profits are able to make new highs. You aren't necessarily seeing them having to hire a lot of people. And just as there's a K-shaped economy, meaning you got Tale of Two Cities for the consumer, there's also a K-shaped economy for corporates. So meaning all of the economic growth or corporate or earnings growth is coming from this small cohort of names at the top, whereas the rest of the industry or rest of the market is really languishing.
You talked about the lack of or the reduced volatility in the bond market. Truth, without question. You mentioned was this time last year, 10-year yields went from 3.6% up to almost 4.6% after the Fed cut 50 basis points in September. We cut, I think, interest rates, 10-year yields went below 4% for like a minute and a half, and we spiked up to 4.20. We're 4.15. The question, long-winded, is where do rates go from here? Yeah. More importantly, when does it matter? At what level does it matter on the downside, and at what level does it start to matter on the upside?
Yeah, I mean, the 10-year yield, from a technical perspective, doesn't look all too inspiring. It's below all of its moving averages. It's near support at the 4% level, which has been fairly important support over the course of the last couple of years. So a break below that, we'd actually say the interpretation would be that the bond market is really concerned about growth. And our baseline, when people will ask, okay, is good news good news? Is good news bad news? How does this work? Say, look, at the end of the day, risk assets, credit and equities, like growth. They need growth. And there's only short periods of times where they will celebrate bad news because they want more stimulus. But usually it's bad news that's only bad enough to get the Fed to move, not bad enough for you to cut your earnings estimates. So if the bond market is sniffing out the growth is far weaker and that the Fed's going to have to cut more and the unemployment market is weakening in a more meaningful way, what that means is that the 8% earnings growth that's baked in for 2025 and the 13% earnings growth that's baked in for 2026 looks to be more of a challenge. Because here's the kicker. When you break apart that earnings growth for 26, what you see is that the Mag 7 is expected to decelerate from 32% this year to about 12% next year. And if you look at the equal weight S&P 500, it's expected to accelerate from 6% to 16%. So what the market has is this assumption that Mag 7 will decelerate, but don't you worry, you're going to get the rest of the market coming back up. Well, surprise, surprise, that was the expectation for this year. And guess what happened? Mag 7 outperformed and surprised to the upside, and equal weight underperformed, and those estimates are still getting cut.
So under that scenario, what's the right multiple? The market's clearly willing to pay up for what we're in the midst of now. What's the right multiple in the scenario that you just put out there, where it's weakening to the point where, the Fed's cutting and the market starts to sniff that out?
Yeah, I think it's an interesting question of where would multiples bottom in the next kind of growth scare environment, and a growth scare that lasts more than 2 weeks, right? We had a growth scare in April and it lasted 2 weeks, and then everybody's estimates starting to go back up. Is it as low as we got to back in 2016 or 2018 or 2020
Which
or
was
2022?
like low teens.
Low teens, 14 to 16%. Oh gosh, that's a long way away from here.
X the major tech companies.
No, that was
That was
inclusive.
the market.
Really?
So here's what's wild is that if you look at even going back to pre-pandemic, you saw the Russell 1000 growth, or you saw the Mag 7 tech names, and the earnings of the equal weight S&P 500 effectively be the same. But then something changed after the pandemic, and maybe it's all this push to the digital world, and of course ChatGPT in 2022. But over the last 7 years, so this is including the 2 years prior to the pandemic, this stat is wild. The Mag 7 has grown earnings. This is the Bloomberg Mag 7 index. So this can be skewed by the weightings that they have. So this is not an average. But the Bloomberg Mag 7 index has grown earnings by 730%. The equal weight S&P 500 has grown earnings by 60%. So when we think about what used to happen was these things actually used to move in tandem. And now they're just in a league of their own, like Rosie O'Donnell.
Good movie.
Great movie.
Do you like the Gina Davis portion of the League of Their Own, or Lori Petty, or off the board from Madonna?
Oh man, full Madonna all the way.
Full Madonna. Okay, fair enough.
Yeah.
Who else was on that squad? It was a pretty...
Rosie O'Donnell was on that squad, and Rob Reiner's daughter
Really?
was on that. Remember, I think he directed or produced
As
that
you
movie.
say, she's just an old soul. She's
I-
got this
yes.
pop culture. You're just a well of it when you say so.
Yeah,
Hey,
I
one
agree.
thing we wanted to hit really quickly while we were talking about the estimates, right? So this was John Butters, earnings insight analyst over there at FactSet. And Guy and I were noodling over this. He had a report out this week. The Q3 bottom-up EPS estimate for the S&P 500 increased by 0.3% during the quarter. This marked the first increase in EPS estimates during a quarter since Q4 2021, which was also 0.3%. So if you look at the chart, and we'll put it in the show notes, you have all of these decreases over the quarters. So you're starting the quarter here, the numbers are coming out throughout the quarter, then you're beating those lowered sort of, right? And then then the stock market kept on going. This is 23 up 25%, 24 up 25%. Here we are up 13%. I saw a stat about Q4. When you come into Q4 up 13% or so, on average, 80% of the time you have a 4.5% gain, between now and the end of the year, that sort of thing. So we've seen multiple expansion, right? We've seen estimates now for the first time kind of tweak up during the quarter. What does this say to you?
Well, those stats always remind me of Brian Fantana. 60% of the time
Brian
works every
Fantana.
time. Do you know which one that is?
Yeah, I do. It was from
Anchorman.
Anchorman.
Oh,
Yeah,
man.
yeah.
Okay. I think that the interesting thing...
Paul Rudd.
Paul Rudd.
Yeah.
That's
There you
Paul
go.
Rudd.
See
That's a good
what I
job.
did?
Yeah,
Yeah.
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 You didn't even need to
What is
find-
it? 60% of the time
It
it
works every
80%.
time.
Oh, yeah. I love that.
So what's interesting about earnings estimates if we contrast with the second quarter, because the second quarter we had huge beats. And part of that was the function that everybody thought the tariffs would hit immediately. And they didn't, because companies didn't have to experience the tariffs immediately. There was all this uncertainty, all these delays about which ones would go through or not. At the same time as companies were really reticent to pass on tariff increases to customers. They had the benefit of things like FIFO accounting, first in, first out. So my inventory might be costing more, but I'm not actually having to recognize it in my EPS, in my GAAP EPS, because of that accounting. So you had this benefit where people slashed estimates, and then you were able to beat them by a pretty significant margin, by about 6%, really substantial. And one of the other key points about that is that you had bank earnings be also a really big source of upside surprise in those earnings. So the question is, yes, you've seen them go up by 0.3% for the third quarter, but is the bar still too low? And could we see a repeat or even a three-peat after the beats that we had in 1Q? Could we see that repeat in the third quarter? And I think that's why people have been chasing this market in September, because they're like, oh man, I don't want to be caught on the wrong side of these beats and raises. And that's where valuation might start to kick back in. If your stocks don't go up on good news, on great news, then it could be a sign of some exhaustion. But we still get back to this just simple notion. If 12-month forward earnings estimates are making new highs, the market's likely going to do it too.
A lot of debt maturing over the next year or so. I think it's close to $10 trillion, $9.5 trillion or something.
And that's just the maturing debt. That's not even the additional debt from the deficit.
Which is a huge number, right? $1.5 trillion, though. It's something crazy in terms. So yes, a big number. Global rates have been going higher. All across Europe, you've seen rates going higher. JGBs have moved up in terms of 10-year Japanese yields, which has only been around 30-year JGBs, which have only been around about 30 years, are basically at all-time highs. A lot of strange things going on in the global bond market. No impact here. Is there anything on the horizon that suggests that maybe we should be paying attention to that?
Yeah, I mean, it continues to be this worry of the market that you're going to see the bond market vigilantes wake up from their ever-long slumber and come prevent the Treasury from being able to do what it wants to do. The 30-year yield, interestingly, in the U.S. is broken down below its moving averages. Let's see how it progresses over the next couple of weeks to see if it looks like it's putting in a top. But it's pretty surprising that the 30-year is trading so soft, given the fact that we're not only questioning Fed independence, which we would expect to show up in longer-term term premia, but you have all these big deficits. And I think the bond market effectively believes two things. They believe the Fed's going to be right about inflation, that they're going to get inflation to 2%. Because if you look at long-term inflation break-evens or the 5-year swaps, which is effectively inflation in 10 years, they all have inflation remaining subdued around just above 2%, effectively saying the Fed will be successful. The other thing is that the bond market certainly doesn't seem to believe that Treasury is going to be forced to issue a lot of long-term debt. They don't think that it doesn't seem it's priced for that to happen. As well as it doesn't believe that you're going to have a completely dependent Fed or completely captured Fed. So all of these things are pretty bold statements by the bond market of what it's currently believing. Let's see if it gets proven true or if it gets challenged.
All right, what would happen if the Fed is kind of in a tough spot because we have a protracted government shutdown? And what if that would cause them at the end of this month to maybe do a 50 basis point cut? What does that do? Because I think we can all agree that whatever happens, whatever sort of economic growth we sort of lose, whether it's 5 days, 5 weeks or something like that, we'll kind of get it back at some point, maybe, or no? Or does that just kind of tip the labor market, especially after we've had, this really funky period over the last 4 months or so? I'm just curious, like what would a surprise, and no, CME Fed Funds futures will start to sniff this out in the not so distant future, but what would more cuts because of weakness, because of something that was unforeseen mean for, let's say, the markets in general?
I wake up in the evening and I ain't got nothing to wear or say.
I wake up and that's another song lyric.
Yeah, that's Dancing in the Dark.
You know what you can't say anymore? Oh, that is Bruce Springsteen, the worst song on Born in the USA.
Wait, that is not the worst song. That's one of the greatest songs ever.
It literally is the worst song.
You know my feelings about you.
I will take this to the grave.
No,
absolutely
as
not.
will we, by the way.
Wait, why is that the worst song?
Not only one of his worst songs, that might be one of the 5 worst songs.
You know what? You can get out of this room.
I may just have to.
Well, if you kick us both out, you're gonna be podcasting with Bill over there, which
Bill and I will
be kind of fun.
We'll have a great, funny conversation.
I thought we're still waiting for him to say something funny.
Bill's funny,
but whatever.
Yeah.
I thought you were gonna say, and maybe it's too soon, but wake up in the morning feeling like P. Diddy.
Oh man, Kesha?
There you
Oh
go.
yeah.
I love Kesha with that
the
dollar sign for the
Yeah.
Kind of like risk reversal, by the way.
Kind of.
Yeah.
Yeah. Look, I think that we have a few dynamics happening. One, we don't know if we're going to get the data. That's why I said dancing in the dark, because we're going to be going through the next couple of weeks. If we have a continued shutdown, we'll go into the Fed meeting, which is on October 29th, I believe, potentially not having all the data that they need if this is a protracted shutdown. There, it's likely that we're going to start seeing signs that, yes, if these are not furloughs but are firings, this is certainly where the Fed would likely move 50 basis points. So maybe the best sniffing tool will be the Fed funds futures, because it will, if we start pricing in 50 basis point cut with what's going on in those futures, then potentially that's sniffing out that there's a bigger impact to this. But usually shutdowns are something we fade, but that's because they're temporary and they're impacted jobs.
All right, the bond market's been muted in terms of response, but the U.S. dollar has been weak the majority of the year, and there's been no meaningful bounce. And I think this is the worst year for the U.S. dollar since 1973. Does not seem, equity markets actually cheering that on. A similar question to the bond market. When at all does it start to care about I think, a significantly weaker U.S. dollar?
What's interesting is that all of the dollar weakness happened in the first four and a half months of the year, and it's been sideways.
Treading water.
And treading water since. Now, it's tried to rally a few times, and it just gets smacked right back down. It hits resistance and fails, but it hasn't broken down below key support. So we're watching 95, 96 on the DXY.
Yep.
If that breaks down, we would expect 90 to very much be in play, because you would be breaking down off of that important resistance. I think the one thing to note as well is we watch really closely what goes on with dollar futures positioning to get a sense of, are people way underweight or overweight the dollar, because what you typically see is that lows or highs in the dollar coincide with the shortest positioning or the longest positioning. Some of that positioning, just as a note, has recovered, meaning that people have covered their shorts. So I would not be surprised if there was more dollar weakness, only because that positioning is not as extreme to the short side.
All right, so you were just talking about the concentration of earnings growth, right, from those top mega cap sort of names. They also have a lot of overseas exposure, right? So if you think of, yields that have come in, right, a bit over the last, what were we hitting, like almost 5% or so a year ago? Is that right? We got up to 4.6, 4.7 or something like that. And then we have all this dollar weakness. Is that a huge tailwind for U.S. multinationals? Is that going to drive a lot of this earnings growth that you could see happening?
Yeah, maybe. The point about the dollar and its impact on equity market returns is that, yes, a weaker dollar might help multinational earnings, but what we find is that a very weak dollar actually tends to drive U.S. equity market underperformance versus rest of world. And what you see is that the only times that you have seen major bull markets in non-U.S. stocks have been when we've had major bear markets in the dollar. So you had one in the mid to late 80s, as well as a major bear market in the dollar in the 2000s. Both of those were massive periods of huge outperformance by international stocks. So if we see another leg lower in the dollar, I'd actually think that there would be more opportunity in non-U.S. stocks, just because of that typical historical relationship.
Dan mentioned you're an old soul, and he means that complimentary, which means I know you've been watching the gold market, because that's an old souls type of thing.
It is.
Talk to me about gold. What is it telling you?
Yeah, I think gold is this encapsulation of so many of the different fears that people have, whether it is a captured Fed or risks of dollar debasement. The idea that you would be running fiscal and monetary policy hot at the same time, you'd be accepting of higher inflation, that is causing people to demand more gold. You have this weaponization of the dollar post the Russia invasion of Ukraine and our response to it, which sanctions, which is leading at the margin more people to shift money, more central banks to shift money into gold versus holding dollars. You put that all together, and it has created this incredible backdrop for gold to defy what has gone on the dollar at certain points. Of course, the dollar weakness this year has contributed to it, but also allowed gold to defy what's going on with real yields. Usually gold is very sensitive to what happens with with real yields is completely broken down. So from a technical perspective, you can argue very clearly that gold is overbought, but guess what? It's been overbought for quite some time. It got overbought, and remember, correction, an overbought condition can correct itself by one of two ways: by price level or time.
Yep.
And gold corrected its last overbought condition through time. So, clearly it's a powerful chart. Clearly it's something to know that, you could easily see, a pullback, but, the trend is up. And I don't necessarily see that these debasement fears are going to go away, mostly if we're talking about a Fed that's trying to talk its way into significantly lower rates and a treasury that's going to spend a lot in deficits.
Yeah, so two questions relative to the gold. Why do you think that Bitcoin of late has underperformed? And then also, what sort of demand do you guys see from NewEdge clients in general for the Bitcoin?
Yeah, so we think that gold and Bitcoin have a similarity in the sense that they are psychological commodities. We actually think of them as part of a real asset allocation, where if you think about any asset allocation within the market, or within different asset classes, even something like fixed income. On one end, you have really risky things like a high yield bond versus something that's very safe, like short-term investment grade corporate debt, AAA, right? So just within every allocation, you have risk off and risk on kinds of exposures. Similar within real assets, where gold has typically been more of a defensive risk off, where you have to have kind of more risk tolerance, volatility tolerance with Bitcoin. But they're both the psychological commodities because they both benefit from these similar fears about debasement and profligate spending, etc. But Bitcoin has a different factor to it that must be appreciated, and it's liquidity. It does well in abundant liquidity environments, and it tends to do poorly in poor liquidity environments, even if those debasement fears are still present, like a year like 2022. So could Bitcoin's weakness be telling us that maybe at the margin liquidity is becoming less abundant? I'm not sure. It hasn't made new highs, but some other things have been making new highs, like non-profitable tech stocks and high beta stocks, all areas that you would typically think that there would be a fairly strong correlation. So it's something we're watching closely, because if that starts to break down, that would be kind of bringing it back to that liquidity discussion, maybe the canary in the coal mine that liquidity is becoming at the margin slightly less abundant.
In the RIA world, you would think performance is the number one factor that clients look to. It turns out it's not. It's accessibility, it's communication. You guys are number 3, as you mentioned, which again is remarkable, which means you're obviously servicing your clients extraordinarily well. What are their biggest concerns when you talk to people?
I think the hardest thing that people have to deal with right now is that if they're sitting on cash, let's say they had a liquidity event or they've been sitting on the sidelines, what do you do?
Right.
What do you do today in an environment where, as we've talked, valuations are so very high and expectations for growth are high? And, not to have a plan and get punched in the face, but having a plan is really important in this kind of environment where you have a structured plan that can be responsive to market volatility, to say, I'm going to put capital to work each and every month, but if we have a pullback, let's accelerate. And part of that takes the emotion out of the buying. Part of that takes the idea of I'm just going to wait for a better price, and then that better price doesn't come, and then you end up chasing at times that is more inopportune. The other part of it is that we've been arguing for the last year that clients should look for opportunities to get exposure to things that don't rely on the S&P 500 making new highs. So we've done a lot of work on infrastructure. It's something that we find to be under-allocated to in most of our client portfolios because it just wasn't as exciting. If the NASDAQ's giving you 20, 30% a year, why look at infrastructure that's 9 to 12%? Well, it becomes interesting in a world where it has much lower correlation to public markets and has that kind of stable return. So we've been focusing on that. We did a really fascinating uncorrelated strategy at the beginning of the year where we were doing things like litigation finance and employee retention tax credits and water rights in Texas, like things that just don't care what goes on in the market. And that's where we're always sniffing putting our nose out to try to find areas that don't have that same kind of correlation that we can build into allocations.
Litigation finance. So you basically finance and take a chop of whatever is then subsequent, whatever disbursement comes from it. Whatever, is that how it works?
Yeah, and it's a great kind of maybe it's one of the things that you can get close to an anti-fragile asset, because when stuff hits the fan and volatility goes up and you have a recession, you typically see legal actions start to go up as well. So it has some really fascinating characteristics as a portfolio builder just because it's so out there.
Let's talk about infrastructure. Define that for me for a second.
Yeah. So it can be everything from your traditional public infrastructure, which you would typically think of as roads and bridges, toll roads and that type thing. But it can also include digital infrastructure and power infrastructure. And so because you have some of these mega trends that are happening where we've underinvested in traditional infrastructure at the same time as there's huge needs to build out for power demand for AI data centers, that we see this big tailwind of this continued need to spend, which we think will support kind of a stable return, even if we go into a weaker economic period.
Right. So, and that's where I wanted to kind of go with this. So if you think about the GDP contribution of just the infrastructure build for data centers and the like, and then really what needs to happen from an energy standpoint, aren't these themes getting a little full right now? And so that's, I think everyone wants to focus on the chips and, the large language models that are being traded and then the servers and the data centers and so on. There's not enough energy right now. So like you see these huge contracts that, OpenAI says they're going to pay Oracle $100 billion over this. Here's 10 right now. Meta is saying to CoreWeave, here's 14 billion. I mean, it's just contract after contract. It takes a lot of money to build out this infrastructure. It takes time, right? It also takes demand, right? So all of these things are being taken just as a certainty right now. So I just wonder whether we're going to have this sort of overbuild, and you could have said that last year. You could have said it the year before, but things are really kind of they're hitting a fever pitch right now.
So the observation from the tech bubble was that those that benefited from the build out of the infrastructure for the internet were very, very different than those that benefited from the application of the internet into their businesses, which means that we have to think of that today as like right now we're in the infrastructure building portion of this cycle, the capital intensive portion of this AI cycle. And the winners of that CapEx portion are very clearly the chips names and the hyperscalers who are building these data centers. Will that be different once this infrastructure is built and we start doing the applications, meaning that the winners will become something else? That is very possible. The other thing that fascinates us is that if we think about the hyperscaler and kind of Mag 7 business models, a lot of them are effective monopolies with very, very low capital intensity. You think about a Meta or a Google, Amazon a little bit different because it has a massive trucking network, but its web services, it has that low capital intensity. So you have these monopoly businesses that don't need a lot of capital to generate a lot of returns. But now, all of a sudden, they're having to invest a ton of capital into a business that is by definition more competitive because it's an arms race. Of course it's competitive. They're all trying to get to this general intelligence, right? So the question will be is that if it's an arms race to get to AGI first, meaning whoever gets to the top of that mountain first is going to win, then are we going to see return on invested capital compression in everybody else? Meaning you've just spent a lot of money to lose a race. Right. And so I think that what is likely going to happen, and the market may not care about this today or tomorrow or even a year from now, but eventually I think it will, is that people will look at these businesses and say, wait, they're not monopolies anymore. Everybody's competing. ChatGPT, we can't raise prices as much or whatever it might be because there's so many different models out there. But I've just spent a lot of money in order to build the infrastructure for it. My return on that invested capital is likely going to be lower. And eventually, I think the market cares. But here's the kicker. Mag 7 has grown earnings by a compound annual growth rate of 40% over the last 5 years. 40%. When you're growing earnings by 40% and you're a $1 trillion plus company, you can do whatever you want. If that growth rate starts to slow, I think that's going to be the effect of Warren Buffett tide receding. You'll start looking at these companies and saying, this person can defend their ROIC, but this person can't. And that's when you're going to start to see more divergence between the returns.
Yeah, and it won't be hard. It'll be Oracle. It'll be CoreWeave. I mean, Oracle has negative cash flow, right? And for the first time since 1992 to compete in this arms race. They had low single digits market share in this cloud business, and now they have all these contracts, and there's a whole host of other things going on. They just hit the debt markets. They're going to have to raise equity. They're going to have to raise more debt.
But the debt markets want it. I mean, that's what's wild. It's like the deals are oversubscribed, right?
Right. I mean, for now, I mean, if anything, that's not bullish to me, right? And so someone flashed, and this is a very, but it's getting into private credit. Did you see these charts that were going around the S&P versus, let's say, these private credit funds? They've just diverged massively, right? So there's a lot of this going on under the surface, and I think you just did a great job encapsulating what the thesis is right now, why these companies are spending 25-30% of their revenue to kind of build this out. They've all said they can't afford to lose this. But the issue here is that the thing that they're building towards, or the folks that are on the application layer, using this compute, it's all going to be commoditized. You use the term AGI. AGI is going to be table stakes in 3 years. And then it's going to be everyone moving towards super intelligence, right? So they keep moving the goalposts a little bit, and every step along the way, if you are Oracle, how are you going to compete? You're going to compete on price, right? Because you're going to need to take market share. And so at some point in the interconnectivity of all these customers and all the revenues and, all the pressure to kind of stay in the game, it's going to be nasty, like when the things slow down a little bit. And especially, and what if we wake up? We were just spending the first 10 minutes of this before we turned the mics on playing with ChatGPT, Perplexity, and Gemini.
No, we were not.
No,
I was.
You were.
I know,
yes.
and I loved it. But you guys, I'm not lying to you, are going to be smarter for it, to see how people are interacting with these things right now. Because right now, OpenAI is expected, oh my God, if you're listening to this, I mean, you guys, the two of you, your faces are absolutely hilarious. But think about this, OpenAI might do $12 billion in revenue, which is astounding. And right now, most of that is coming from people like me who are paying $20 a month, but I'm also paying Gemini and I'm also paying Perplexity because I want to see how all these different things work. At some point, the behavior of search that we've all had our whole adult lives was free. You know what I mean? So at some point, people are not going to be paying for this. It's going to be ad supported. You know what I mean? So I guess my point is like we're not far off from this sort of thing not being as interesting as it is right now to nerds like me. Now, the applications for enterprise and all that, that's where all the money's going to be made.
I think it's also fascinating is that the benefits or spoils of AI thus far, outside of those building out the CapEx, which is a bit of a circular reference because Mag 7 is sort of selling to itself in many ways. But these companies, the benefits of the AI has really been applying it in their own businesses. Right? Meta has benefited from AI, not because the Meta AI is great on Instagram or WhatsApp. It's actually not great at all. I don't know if you ever tried to use it.
No, Meta AI sucks. And that's why they just spent $1 billion trying to acquire talent away from OpenAI and the like, because they know it sucks.
But it appears that some application of this technology has allowed them to raise prices faster 100%. On ads. And you've seen huge revenue growth from them, but headcount has remained fairly stable. So there's something there that they're applying this to their own business that's making them more efficient. So the question is, how much more kind of employee efficiency can Meta get? Is that coming from AI? Meaning, is there a lot more that they can get out of their existing employee base? Because is that effectively the test subject for how other companies can use AI? Or is this very unique in the fact that they're developing it for themselves? A lot of interesting questions that pop up because we really haven't seen a lot of evidence of AI's impact in other places.
Well, you're 100%. I've said it all the time. I've said it a lot that the two biggest companies that I've noticed, and this now is 4 or 5 quarters in terms of being able to sort of lever AI, is Walmart in terms of their margins and Facebook in terms of theirs. And there's a wide gap between the next companies that are able to figure it out. And it speaks to return on invested capital, as you said. It also speaks to that MIT report that suggests more and more companies will start to look and say, where is the return from this investment?
Where's the beef?
Right.
Why? But there's something interesting. So that's a great narrative, okay? And it's one of the things that has actually powered Meta over the last year and a half, despite the fact that Meta AI has, just really fallen down every step of the way. there was a headline last week, I think, that Meta is looking to do a deal with Alphabet's Gemini for ad targeting software. What does that say? They've been spending hundreds of millions of dollars to acquire talent, and now they're looking to basically, do a deal with their largest competitor, or one of their largest competitors. So I just think we're in a sort of period now where I don't hear any bulls on this entire theme questioning how it could go pear-shaped. It just seems like they're tripping over each other to kind of create a different narrative. I don't know if you've seen like the memory stocks. Have you seen like Western Digital and Micron? These stocks literally have gone parabolic. Western Digital is up 350% off its April lows.
I've bought so many hard drives, as probably all me.
Right. I mean, but they have NAND flash and the like. So it's just really interesting that no one can see how this thing could slow down or even end.
I mean, here's how it could. Remember, all of these businesses are still cyclical. Meta is an advertising business, Amazon consumer products business, Apple high-end consumer products, Google advertising, on down the list. And so in a world where if the economy slows down, and we actually don't think that 2026 GDP estimates are all too far off, but let's say that.
So you set up 13% or so, that's consensus?
That's consensus.
Wasn't that consensus coming into this year?
It was high, then it went down to mid-single digits, and then they reaccelerated high. 8%.
But, if we are in a world at some point where economic growth really does kind of slow down in a more meaningful way, remember, Meta had negative revenue growth in 2022 because everybody was afraid we were going into a recession. If you're afraid you're going into a recession, you don't spend on advertising.
Right.
So I think that there is an aspect here where they have benefited from an economy that has been better than expected, but they've also benefited from the fact that this economy has been highly, highly concentrated in the AI CapEx, tech CapEx spend as well. I mean, I think that Neil Dutta put out an amazing chart after the second quarter GDP that said, look, there was a greater contribution from tech CapEx than there was to the GDP growth rate than there was in the entire U.S. consumer, which is wild. But it shows you that just as this equity market is hyper concentrated, the economy is as well.
Last question. Okay, that point, and we've talked about that. We had Neil on the pod, as you just mentioned. If we have a consumer slowdown because the labor market is weakening, then you're going to see a pullback in advertising, which is the lifeblood of those businesses that we just talked about. And won't they eventually have to slow down that CapEx? And if you're seeing this contribution of those two pillars, consumer, which we've gotten very comfortable, has been 2/3 of GDP. And now if you think about that contribution from the data center and the AI infrastructure build, if that comes in, do we finally have a recession? Because we just talked about it in 2022, people were not spending on those sorts of things. It wasn't until Meta and Netflix and a bunch of these other companies started cutting headcount until those stocks started working and bottomed in late 2022.
I think that if we're thinking about the U.S. consumer, we have to talk about the K-shaped economy. And the fact that there was a Moody's report that came out a couple weeks ago that highlighted that the top 10% of income earners generate 50% of the consumption in the U.S. Here's the thing to remember. The top 10% of wealth, which can be different than income earners because wealth can just be people who are retired that have been in the market for a long time. But that top 10% of wealth owns 80% of U.S. equities. So there is a circular reference of wealth effect that is happening with this top income earner because they are benefiting from the fact that U.S. equities remain so strong, which is, again, dependent on this AI story. At the same time is that we have to also remember that the majority of savings in the U.S. comes from top income earners. And here's an interesting kind of through the looking glass dynamic, which is that top income earner has been enjoying very high interest rates. If the Fed were to cut by another 100 or 200 basis points, interest income is going to go negative. And interest income going negative is actually more of a restraint on that consumer than the benefit they're getting from lower interest expense, because that consumer tends to not carry credit card balances. They tend to have a fixed rate mortgage. So you could actually have an environment where the Fed cutting interest rates for this all important high income consumer actually at the margin is more restrictive than it is stimulative. And it's so sacrilege to say, but I think that that's where the wealth effect gets fascinating as we go into 26, because if you get those cuts, they start pulling back a little bit at the margin, then that 2/3 of growth slows down because it's so concentrated in that high income.
No, listen, absolutely, yes. And the counter to that is the assets that they have will mitigate that, what you just talked about, because the asset growth will be such that that interest thing will be offset. I mean, there's a lot of different, yes, but you're right.
Frank Sinatra has a song that says, "It all depends on you." And it really is, it all depends on AI, because now what we're seeing is that not just the economy depends on AI tech CapEx. The equity market, of course, depends on AI-related earnings. And because the consumer depends on the health of the equity market, the consumer, in a second derivative way, depends on AI as well.
Well, you know what she's saying? That AI has the world on a string.
I like that.
That's nice. That was
Should
well
we
done.
wrap right there?
Absolutely.
Okay.
Cameron Dawson, Chief Investment Officer at NewEdge Wealth. Always great having you. April was too long ago. You got to come back before the end of this year.
Come fly to new highs with me.
That's another name.
Wait, by the way,
potential.
before we get out of here, so you did your Dancing in the Dark. Guy's got a Glory Days thing. You have no idea. We can go to the Wikipedia. We'll put it in the show notes.
Glory Days is an awful
hold on.
song.
What year was it?
Stop. Would you stop?
No, Glory.
Wait, was it 1981? Guy Adami playing
me.
for the Croton
1981.
on Hudson football Badgers. What were you guys? I don't know.
The Tigers.
Tigers.
Still are
Close
the
enough. He had a 105-yard interception taken back. He just ripped that thing. Pick six in the
Had
end
wheels
zone.
back in
Do you
the
know
day.
that? So those are some glory days right there.
I mean, the sports stuff means nothing to me, but congratulations for peaking early.
Thank you. You're correct about that.
Yeah.
40-something years ago.
Now we got to rip it on that one. Thanks, Cameron. That was awesome.